Okay, folks, I'm going to provide a little short video on equilibrium in the market, and then I want to explain what happens when there's a shift in the demand curve and the supply curve at the same time. So for those of you in my online class, we'd be looking at, I believe it is slide 26 and slide 27 of the third lecture, the one on supply and demand. So the first thing we're going to do is draw a market graph. Over here we've got our graph in the top quadrant. We've got quantity on the x-axis, price on the y-axis. Our demand curve is downward sloping. Our supply curve is upward sloping. So here's another thing to consider if you're in my class. There will be graphing short answer problems on the first exam, on all exams. And one of the things that I'm looking at is that you draw the graph correctly and that you properly and fully label your graph. So let me know that you know that this is a quantity axis by putting a Q on the x-axis, and let me know that you know that this is the price axis by putting a P next to the vertical axis. All right, in our market we've got one price. It's called the equilibrium price. I'm going to call that PE, that brings the quantity supplied, points along the supply curve or quantity supplied, in line with points along the demand curve. So at PE, quantity supplied is equal to quantity demanded, and we can just go ahead and call this QE. All right, so what happens in a market when we get a price other than PE? So just imagine that we get a price of P high. All right, now by P high, I don't mean you look at this and you freak out and you say, oh my God, it's really high. All we're saying over here is that this price that we're calling P high is above the equilibrium price. All right, so how do consumers and producers react to a higher price, or a price that's higher than the equilibrium price? Consumers move down the demand curve from left to right. They keep on moving until they get to P high, and then what we can do now is drop a line down to the quantity axis, and this would be the amount that consumers would demand. So we'll call that QD. Okay. What about producers? Well, producers are going to move from left to right up the supply curve. Remember, we're saying that the price in the market is not PE, it's P high. So they're going to blow right past PE. They're going to keep on going until they get to P high. And then what we'll do is we'll drop a line down to the quantity axis, and we'll call this QS. So what's the problem we have here? Well, when we're at the equilibrium price, the quantity supplied, points along the supply curve, is equal to quantity demanded. When the price is here at P high, quantity supplied is greater than quantity demanded. Whenever quantity supplied is greater than quantity demanded, we have a surplus. Okay, so how will the market take care of the surplus? The key here is to understand that if prices are free to adjust, what we expect will happen is that the market will clear the surplus all by itself and will eventually get back to the equilibrium quantity because the price will adjust from P high down to PE. All right, so imagine you're a producer, you've produced this product, but nobody's buying it because the price is too high. What are you going to do? You're going to offer to sell it at a lower price. When you offer to sell it at a lower price, that'll bring in some more buyers. So now maybe this becomes the price over here. Do we still have a surplus? And the answer is yes, we do, but this surplus is a little bit smaller. So some other producers will lower their price. That'll bring in some more consumers into the market. We're still going to have a surplus, but this surplus is getting awfully small. And finally, when the price adjusts to PE over here, the surplus is basically gone. In other words, there's no more surplus. The number of quantity supplied is equal to quantity demanded, and the market is taking care of that all by itself. Now, how quickly does this happen? It depends on the market. Some markets clear very quickly, like if we're talking about the stock market. Every time buyer and seller get together and they agree to make a trade, that's essentially setting the price for that period of time, so that happens very quickly. If on the other hand we were talking, let's say, about the housing market, that is not a very active market. It could take a lot longer for this surplus to clear. But if there's nothing getting in the way of prices adjusting, what we expect is going to happen in a market like this where the price is too high, and by too high we mean it's higher than the equilibrium price, is that the price should eventually come down until quantity supplied falls in line with quantity demanded. All right, so that's what happens when we have a price that is too high. Let's go ahead and take a look at what we expect is going to happen in a market when the price is too low. So let me clean up the board over here. That's what I'm doing right now. And then what we'll do is we'll see what happens according to economic theory when we have a price that is too low. All right, so clean this up over here. And I'll actually probably redraw this a little bit. We'll keep this PE as our equilibrium price, all right? And this time what we're going to do is we're going to say that the price in the market is low relative to the equilibrium price. So I'm going to call this P low over here. And so we're saying that for whatever reason, this is a price that actually prevails in the market. And what we want to do is we want to take a look at how consumers and producers react to a price like this. Now, by the way, once again, by P low, I don't mean that you look at this price and say, wow, that's cheap. This might actually be a high price. It might be a very expensive price. What we're saying is that what makes this P low is that it's below the equilibrium price. In other words, there's some price that exists in the market that will bring quantity supplied into line with quantity demanded, and the price that we have in the market is less than that. It's what we call P low. All right, so how are consumers and producers going to react to a low price? Well, consumers are going to move from left to right down the demand curve. They're going to keep on going until they get to P low. What we're saying is that forget about PE. PE doesn't exist in the market. We're just going to blow right through the equilibrium price over here. And once we get to P low, we can drop a line down to the quantity axis, and this would be quantity demanded. All right, what about producers? Producers are going to move from left to right up the supply curve. They're going to keep on moving until they get to P low. Once they get to P low over here, we can drop a line down to the quantity axis, and this is quantity supplied. All right, what situation exists here or what exists in this situation? Well, we've got a quantity demanded that is greater than a quantity supplied, and whenever quantity demanded is greater than quantity supplied, we have a shortage. All right, so what is the story that I'm going to tell you? In a market where prices are free to adjust, that's the key. There can't be anything getting in the way of prices moving up or moving down. The market will take care of this shortage all by itself. So imagine that you are a buyer of this good. You've come into the market because you see that the price is here at P low. Unfortunately, though, for you, you're not able to buy any of this good at the price. How might you react? You might offer to pay more. So if you offer to pay more, that will bring some more supply onto the market. It's also going to shake some people out. In other words, there's a lot of people who want to buy this product when the price is low. But now if the price all of a sudden were to rise to this level, some of these people will say, I don't really value it that much. It's not that important to me. So what's going to happen is we're still going to have a shortage, but this shortage is going to get smaller. And if more people offer to pay more producers, more suppliers will offer to sell more. And then finally, when we get over here to the equilibrium price, we expect that there would no longer be a shortage in this market. Okay, now how quickly does that happen? Again, it depends on how active the market is. In some markets, this happens very, very quickly. If we're talking about the stock market, again, every time buyer and seller get together and make a trade, and shake hands, then they're essentially setting the price for that point in time in the market. If we're talking about another market, let's say like the real estate market, that could be out of equilibrium for a long time. Does that make sense? All right, so now what I want to do is go to the next slide in your presentation, slide 27, and work through what happens when we get shifts in supply and demand at the same time. Now, I've done this quite a bit. My recommendation for you, because this may be the first time you're taking this class, maybe the only time you're taking this class, maybe after you've been in this class for a while, you say to yourself, you don't want to take economics again. That's fine. But I want to get you through this class. I want you to understand what happens when our supply curves and our demand curves shift. So what I'm going to do is draw our market graph once again. This is quantity over here on the x-axis. This is price on the y-axis. We're going to have a downward sloping demand curve like this, draw an upward sloping supply curve like this. This is going to be our initial equilibrium. I'm going to call this P1 this time because what we're going to do is we're going to shift the demand curve and the supply curve. I'm also going to call this D1 to signify that this is the initial demand curve, and I'm going to call this S1 to signify that this is the initial supply curve. And then I'll drop a line down here to the quantity axis, and this is Q1. And what we're going to do is we're going to look at what happens when we get an increase in demand coupled with an increase in supply. And the story that I'm going to tell you is when it comes to price and quantity, there are three different possibilities. Now, how do I know that there's three different possibilities? I know this because I've done this. I've done this for a while, and so I've worked out the three different permutations. My suggestion to you is to do things the old-fashioned way. Break out a piece of paper, or maybe a couple pieces of paper and a pen and pencil, draw these out, go to slide 27 on the presentation, the third lecture, the one on supply and demand, and work through all the different combinations you see. So I'm doing the one that's kind of in the middle of that matrix, like the middle square of the tic-tac-toe box. And what we're going to do is we're going to look at what happens to price and quantity when demand increases and supply increases. Does that make sense? I want to do something real quick. Okay, looks like it's still going, so I think I'm okay. All right, so one possibility is that we could get this much of a demand shift. So this is our increase in demand, this is D2, this is our increase in supply, so this is S2. And in a situation like this, what happens to our price and quantity? Well, it turns out that there's no change in the price. P1 and P2 are the exact same price, so price did not change, and in this instance, quantity went up. All right. Now, I've done this so many times that I know that this is one possibility that I'm gunning for. It might take you a while to figure out how that's going to happen, but you'll see that this is a rightward shift in demand. You see over here that this is a rightward shift in supply, meaning demand went up, supply went up, and in this particular instance, there was no change in price, but we had an increase in quantity. All right, so what I'm going to do now is I'm going to stick with our increase in demand, and I'm going to change the increase in supply. We're still going to get an increase in supply, but it's not going to be the same increase in supply that we saw before. All right, so this is P1, our initial price. This is Q1, our initial quantity. This is our increase in demand, but this time what's going to happen is we're going to get a baby shift in supply, so this is S2. This becomes our new equilibrium over here, so I'm going to drop a line down to the quantity axis. This is Q2. I'm going to draw a line over here to the price axis. This is P2. So in the second instance, what happened to price and quantity? Price went up and quantity went up. Oh, that's interesting. We've got, in the first instance, nothing happened to price and quantity went up. In the second instance, price went up and quantity went up. Let's try the last one, the last possibility. By the way, it doesn't matter if you shift the demand curve or play around in shifting the demand curve by different amounts or the supply curve by different amounts. You should still get these three possibilities. So let me erase this over here. There we go. This is P1. That's where we're starting out at. Just want to clean up the board a little bit, otherwise it gets pretty messy, right? All right, now this time instead of getting a baby shift in supply, we're going to wind up getting a monster move in supply. So imagine that the supply curve shifts out like that. This is our S2, right? We still have an increase in supply, but this time it's a big increase in supply. So what is happening to price and quantity according to our model? Well, this is our new equilibrium, right? Our initial equilibrium was this. We'll call this E1. This is our new equilibrium, we call that E2. Drop a line down to the quantity axis, this is Q2. And then we move a line like this down over here to the price axis, this is P2. So what's interesting about this is in the third case, price went down and quantity went up. Oh, that's interesting. So one possibility is that there's no change in price and quantity goes up. Another possibility is that the price goes up and quantity goes up. And the third possibility is that price goes down and quantity goes up. So that's why you'll see in the middle of slide 27, it says that when we get an increase in supply coupled with an increase in demand, P is ambiguous, meaning we don't know if it's going to stay unchanged, go up or down, but Q always goes up. So my recommendation to you folks is turn to this slide, break out a few pieces of paper with a pen or pencil. Why am I saying doing it the old-fashioned way? Because if you have to answer a question like this on the exam, it's going to be paper and pencil. So you may as well do it the way do it for homework like you would do it on the exam, so you feel comfortable doing that. So whenever we get an increase in demand coupled with an increase in supply, we're not too sure what's going to happen to the price, but we do know, we're pretty certain that the quantity, equilibrium quantity, is going to go up. Thanks a lot, folks. I'm going to see if I can post this thing on YouTube now.